The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, heading into the weekend on Friday, a mostly up day in the grains and oil seeds, and we'll throw the cattle trade in there as well. And a decent day is also seen on Friday's stock market, energies, metals, etc. So we'll call it a positive end to another volatile week in the trade. Let's break it all down. Joining us for market analysis, Ted Seifert with Zaner Agheads joins us on the show. Ted, how are you, buddy? Have you caught your breath from another volatile week of trading, my friend?
Yeah, I'm good, Jesse. I am ready for a couple days break. I mean, still following the news over the weekend, but at least markets being closed for a couple days, I think is a good thing. Uh, yeah, it's been wild.
Yeah.
Even from one day to the next, it's a completely different story. We are chasing headlines right now, but in the middle of that, throw in a couple major USDA reports here the last couple weeks and weather, just normal ag stuff, but then all this broader picture stuff. When we're talking tariffs, we're obviously talking about our exportable commodities and so really everything, right? I mean, very much head on a swivel. Markets are so very flighty right now, not exactly sure what to do. And when I say that, I mostly mean like equity markets and kind of other commodities. The interesting thing here has been grains. I think if you'd asked a lot of people at the beginning of the week if soybeans would have a sharply higher week, given China at the end of the week they had gone up to 125% tariffs. If you'd have told people that a week ago, I think they would have expected the opposite. But there's some other things at play here too, and some unexpected things that have happened with this whole tariffs on, tariffs off, everything like that. And that's really kind of contributed to that strength. So, yeah, absolutely wild week. I'm going to say corn in particular, though, from the get-go, has really performed very, very well, surprisingly well. And corn just looks pretty good on a chart. So I think from a grain perspective, if you're wanting to be bullish grains going into the growing season, this was about the best possible outcome you could have had this week from a price action perspective.
Well, let's talk about this. You hit on so many key points, and we could spend an hour diving into this. But with all the outside noise and volatility, we're essentially trading markets via social media posts now. With obviously President Trump's post about the tariff pause earlier the week that really sent us shooting higher. Throw in that April WASD that I would say was leaning bullish for corn. And to your point, this corn market has been doing pretty well. I guess, how does someone manage their risk with all of this volatility in the grain markets right now, Ted? And I know that's not an easy question to answer.
Yeah, and there's a tremendous amount of risk in either direction. I think with the strength that we saw in corn and also soybeans this week, I think it's giving you opportunities to manage that risk a little bit better than where we were last week. So I think that's really good. But to throw that in the mix as well is that the longer term forecasts are fairly concerning, especially for the western half of the Corn Belt for this growing season. So I think you want to be very mindful of the potential downside. I don't think it's a good time to say, "Hey, look, the worst case scenario of China putting 125% tariffs on us, it can't really get any worse for us because even if they go to 1,000% tariffs, it's still the same as far as being priced out of the market for China." I think I'm going to caution you to say that's the worst case scenario, because that's not the worst case scenario. The worst case scenario is a global recession where demand really falls across the board. And we can talk about demand displacement and how, China's going to really focus and try to buy as many of their needs in soybeans from Brazil, South America as a whole. And then other countries are going to are going to get pushed out of Brazil, and that demand and displacement is going to come to us, and we'll get more business. Or the loss of the Chinese business will be offset by other countries coming in. And look, that was a big theory that did prove out pretty well in the first round of trade tariffs. The difference being now is you've got a very volatile equities markets globally. You have a lot of concern about what the global economy is going to be like if we get into this extended and very heated trade war with China. If that doesn't get resolved soon, I mean, we could have a very significant economic pullback on a global scale. So when we talk about demand displacement, yes, we will get some other business, but if overall demand is down 10, 15, 20% globally, well, then that displacement coming in isn't going to offset the losses to China, or it's just not going to be what it was this year. So I do think there's a very significant amount of downside potential that the market obviously didn't realize this week, but could over time. I think it's very important to be making your sales as you normally would, have your target orders in there, let them get hit. But I really like the idea, maybe this year even more than the last couple of years, of having those replacement strategies in place. I think it's a great idea to go out and have calls or call spreads for you to express your upside bullishness for weather concerns, but also to really protect some sales made. Like, what if you don't have the bushels, right? You don't want to be stuck in that position either. So, selling futures or selling cash, either way, the same thing. I mean, not exactly the same thing, but that way you really manage the risk to the downside. But then having some sort of replacement strategy to have upside potential, I think, is very important in these markets too. And that's actually, it's called a synthetic put, right? I mean, that's the technical textbook term for that. That I think is a fantastic play this year. I really do think uh, selling cash, selling futures, and then re-ownership of the call strategies for re-ownership is a great idea. And by the way, I'm not saying sell everything that you plan to grow right here, right now. I'm saying at this time of year, we look at what the market and the potential is. We talk to advisors like myself, or you do your own charting or whatever, and you set levels on where you want to sell portions of your crop, right? Do that. Put those levels in. Have those orders working. But also have that reownership strategy in place as well, so you feel comfortable about letting those orders get hit, knowing that you do still have upside potential or that replacement potential. And for me, that's the right strategy to be using right now. I don't think you can just kind of say, "Hey, it was a really nice up week. These charts look really good. I'm not going to sell anything. I'm not going to have those orders working. I'll just roll the dice." I think this is a really, really tough market to roll the dice in this year, Jesse.
Ted, I'd love to ask you, just from a tariff perspective and all of this headline noise, and you do so much work and analysis, and you've been in these markets for a long time. When it comes to the US and China specifically, it seems like that's the end game right now of the Trump administration is China. And it seems like, although we're trying to get deals with other countries, they don't matter as much. It's US China relations. How truly important in 2025 is the Chinese market for US soybeans, US corn, et cetera, from your perspective? Because as we see these tariffs, I mean, at this point, we're what, 145% now? Like, they just keep going up.
Yep.
I mean, how long can we sustain a trade war with China in terms of the ag sector, Ted?
I mean, in terms of the ag sector, look, there's so much stuff that we get from China. Like, what's life going to be like with massive, massive tariffs on China on goods coming in? I mean, how does that change our disposable income? How does it change our spending habits? What does it mean for the overall economy? These are things that really have to be thought about, because they do, maybe not directly, but they will affect the ag sector as well. But your question is specifically, how does that affect agricultural markets and our exports? And really, for corn, there's nothing but upside, right? We've not sold any corn to China this year, really, virtually nothing. I mean, a couple specialty cargoes maybe, but if there was some sort of trade deal, like the first time, although China didn't really hold to it, it looked like it for a moment, but if there was some sort of trade deal and China was willing to come in and sort of make things right, they could potentially buy a lot of corn. It could be a really good thing for corn. But the downside for corn, again, if they're not taking nothing away from nothing, Jesse, is still nothing. So it doesn't really hurt our export business on corn. For soybeans, that's a big problem, right? I mean, China is the number one importer of soybeans in the world, and it's not by a little; it's by a tremendous amount. China is expected to import 108 or sorry, 109 million metric tons of soybeans this year. That's out of 179 globally. So I mean, every other country in the world combined doesn't even come up to half of what China imports. It's a profound effect on soybeans. Um, and like we said earlier, there isn't enough demand displacement in the world to offset China. And if we're in a global economic downturn and countries start, especially your poorer countries or whatever, if eating habits, consuming or purchasing habits move away from higher priced proteins, there might not be as much demand for soybean meal and soybeans. So that's a problem. I mean, you could see global demand coming down 10 to 15%. So overall, I mean, it's a massive, massive, massive problem for our new crop soybean balance sheet. I mean, exports are half of our balance sheet. I don't know how else to get around that. So it's a much different story for soybeans than it is for corn. It is a massive problem for soybeans. The market seems to be shrugging that off at the moment. I guess maybe thinking lower acres and potential weather issues might offset that. We might have better domestic demand, but you cannot increase crush capacity fast enough to offset the loss in exports, in my opinion. So, it's a problem, and it's a problem that has multiple layers. Directly affecting agriculture, and then how does it indirectly affect agriculture as well. I am also going to say that I think it's from a broader perspective. I think it's interesting how this trade war has been approached because, at first it was Canada, Mexico, and China, right? We put on the 25% tariffs against Canada and Mexico, and then 10% on China. We delayed those tariffs against Canada and Mexico for a month, but held the 10% on China. Then we came back in and we did the 25% tariffs on Canada and Mexico, added another 10% on China, but then exempted everything that was under USMCA, virtually getting rid of the vast majority, or 80% of what the tariffs would have been. And then after that, we started getting along really well with Mexico, but then really talked very tough on Canada, which I think was the opposite of what a lot of people were expecting, and virtually zero communication with China. Just stern words, but very few, and really no negotiations. I think that was us showing, or President Trump showing the world, that we can either play good cop, like we did with Mexico, bad cop, like with Canada, or just complete cold shoulder, like with China. And that was the setup going into the reciprocal tariffs and the blanket 10%. Then we put those reciprocal tariffs on, which some countries were really high, like Japan, for example, at 24%. That's one of our best trade partners, right?
Mm-hmm.
And so we really overshot the mark. And then 12 hours after those went on, we lowered it to a blanket 10% to really kind of appease the world market and, give our biggest trade partners a break and show that we're willing to work with them, willing for negotiation. But the country we did not do that with was China, right? So again, cold shoulder, very stern. It's turned into, this is a war directly with China. We want to let the rest of the world that we're serious and that we're willing to work with them. But in particular, we would really like them to drop tariffs on us, but also join the fight against China. This is now a fight 100% against China, and it's not to regain control of the manufacturing sector. It's not to bring back manufacturing jobs to the United States. It's not to get rid of an income tax. It's not, for all of these reasons that were touted. Although these might be happy benefits, some of that may happen to an extent. We're not going to completely get rid of income taxes. We're not going to completely bring back all the manufacturing jobs. But the whole point of this, even though it hasn't been explicitly said, the whole point of this is to stop China from becoming the number one superpower in the world, as they have been saying for 15 years that is their goal. They have a slogan, China 2025, that's been around for a long time, that said there's their motto. They want to be the number one superpower in the world by the year 2025. And they've made very big headways to doing that. And it's because they're the number one manufacturer of all goods in the world, and a ton of Everybody's money goes to China. And this is President Trump's effort to break that and to move that manufacturing into other countries, some of it back to us, but also countries like Pakistan and Vietnam and Colombia and other places, in order to break that big potential superpower from eclipsing us, right?
Mm-hmm.
And that's what this has turned into. And it's amazing how it's really unfolded and continues to unfold. So far, it looks like this has actually been very successful. Now, it does probably mean that we're going into a time frame of a economic recession for both the U.S. and the globe. Even though we did bounce back very well at points during the week in the stock markets, I'm concerned about where we go from here. I don't think this is over, but the end result of this might actually end up being a very, very good thing, and mission accomplished. Maybe I don't know. Again, predicting the future is a very difficult thing to do, as you know. But it's amazing how this has unfolded. Unfortunately, I don't think the fight against China is going to be a quick one, and I'm very worried about what that might mean global economics wise, global demand for soybeans and other things.
Mm-hmm.
So I do think there's a lot of downside potential. And tying this all back into your original question, I do think it is absolutely imperative to be protecting the downside of things. But again, I think there's a lot of reasons to be looking to have some exposure to the upside as well. And again, the best way you can do that is like we talked about, synthetic puts, re-ownership calls, things like that, but also keeping with a marketing strategy of selling, keeping with a selling schedule, setting those target orders and letting them get hit as it comes.
Quick thoughts on the livestock sector. Cattle had a nice end of the week on Friday. Really, livestock's kind of been trading in correlation with the stock market volatility, it seems, Ted. Any thoughts on the protein sector to end the week?
No, you hit it. Really very much correlated with the stock market, right? I mean, if we've got the stock market coming back, we feel better about consumer spending. People are going to spend spend money on higher price beef. And then on days where the stock market's down, cattle are down very much. Beef is a very domestic market. We don't export a ton of it. So it's not really about tariffs so much. It's more about what our spending habits might be based on how we're feeling about the economy. We're going to continue to do that. And as I said, I am rather worried about where the economy goes from here. So there too, I think really some downside protection is absolutely necessary if you haven't already. But take advantage of these days that we have significant comebacks. Friday was a very good looking day.
Ted, if folks want to reach out to you there at Zaner Ag Hedge for a conversation, what's the best way?
Yeah, believe it or not, I've got a ton more thoughts on everything here. But yeah, you can call me directly, 312-277-0113. You can also find us on the web at www.zaner, that's ZANER.com. You can sign up for our afternoon commentary. It's me leaving a message 5 to 7, sometimes closer to 10 minutes, on a recap of what happened throughout the day, specifically in the grains markets. And then if you're on the X platform, I'm at the Ted Spread.
Ted Seifert, Zaner Ag Hedge. Always good to hear from you, buddy. Thanks for joining us on Market Talk. Have a great one. We'll talk to you again soon.
You too. Thanks, Jesse. Take care.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.